Hi guys, welcome back to a new video. This video will show you how to apply smart money concept on synthetic index trading. So if you are a synthetic index trader, you will need to watch this video to the end to be able to apply smart money concept very well. If you're not a synthetic index trader, you can also watch the video because the concept applies to all type of trading. I will use volatility 25 index to explain how to frame a good trade on synthetic index. Now this is the 24 hours time frame, which means is the daily time frame. The first thing you need to do on the daily time frame is to determine the directional bias. Directional bias means the order flow, and the order flow can be determined using structure and also internal and external range liquidity. Now for the structure, we see that price is bullish because we have this expansion and we're seeing price is retracing. So price is bullish. So what do we need to do is to determine that as price taking internal range liquidity, seeking external range liquidity, or has price taking external range liquidity, seeking internal range liquidity. Since we have determined that the structure is bullish and we see this is a retracement from this expansion, which means we have an expansion and then this is the retracement and we see another expansion. Now price has sweep liquidity above this high, which you can name it external range liquidity, ERL. So it's an external range liquidity because we see a swing high has been what? Taken, meaning price has sweep liquidity above the swing high. So we see external range liquidity has been grabbed. Now, as soon as we see this, we will look out for internal range liquidity, preferably at the discount level. Here we have this internal range liquidity as our draw on liquidity. Now we can mark this as IRL. This is internal range liquidity. This is external range liquidity. Now the draw on liquidity is this imbalance because price will seek liquidity inside this imbalance because there is an inefficiency of price delivery. So price need to make it efficient. For price to be efficient, this fair value gap need to be tapped. So after determining that, which tells you that this is the draw on liquidity, you have to look at the previous price range, that is what is on the left side of the market. Now, this is the buy side of the market and you're expecting a sell side of the market. Let me take it again. This is the buy side of the market. This is it. And this is the sell side of the market. This is what we call the market maker model. But our concern is not this. Our concern is how do we frame that this market is going to come into the internal range liquidity. Now watch what I will do. When price seek external range liquidity at this level, when we have price seeking external range liquidity at this level, we see that price has sweep liquidity above this high. And then price close inside the range. What do I mean price close inside the range? Do you see this candle? This is the candle that sweep liquidity above this high. And as soon as price sweep liquidity above this high, we see price came back into the range, meaning into this range from this high to this low. We see price came back into the range of that daily candle and close inside the range. Now this tells us that something is about to happen. I have a video on my channel that explains how to use swing points to know if price is going to reverse or continue. Now we have this particular level here. We see price has swept liquidity above this high, and since price closed inside the range, we can see that the previous daily candle also price closed inside the range of the previous daily candle. Now this tells us that the reversal is about to happen. Now as soon as we see this, we need to identify on the 1 hour time frame, do we have a change in the state of delivery for us to know that this price is going to go bearish? Most importantly, between these two candles that form the swing high, now we can name this as candle 1. Then this one can be the candle 2. Between candle 1 and candle 2, what you need to do is to go to the 1 hour time frame and look for change in the state of delivery, in essence another block. So now if you go to the 1 hour time frame, you will see that between candle 1 and candle 2 there is a change in the state of delivery. So here we are on candle 1 and candle 2. Now, how do you determine your change in the state of delivery? This is the high of candle 1 and this is candle 2. Now the whole of this is candle 2. From this low to this high and from this high to this low is candle 2. This consecutive bullish candle are the change in the state of delivery once price violated. Another thing you should also understand is that before sweep of liquidity above this high, we have these two consecutive candles were formed after this set candle was formed. But preferably, for you to determine the change in the state of delivery, you can also neglect this and focus on this consecutive candle because that one can be negligible. So as soon as you see this has been violated, meaning price has run through the consecutive candle that sweep liquidity, you should know that we have what you call change in the state of delivery. After seeing this change in the state of delivery, what you're going to do is to expect price to come into a reasonable level in the price range that caused the change in the state of delivery. Now, if you put your Fibonacci from this level to this high, to this low, you'll see that price has come into the discount level of the change in the state of delivery. Most importantly is that when you have a large change in the state of delivery, make sure that you take your trade at the premium level if you're going to be going bearish. So here we see price coming into the 60%. That is the optimum trade entry. And so you see price is bearish already. But as soon as you see price is retracing, I want you to pay attention on something. You should be able to see price creating a swing, a confirmed swing at the price level or at a reasonable price level. When price came back to this fair value gap, we can use this fair value gap here at premium level because you have to also seek price coming into the fair value gap. So when price comes into the fair value gap, price did not just start retracing. I want you to look at this. Now, price created a protected high because we see that inside the fair value gap, price created that swing point I show you on the daily time frame. And because we see this candle, this is candle 1 and this is candle 2. Candle 2 entered into the fair value gap, sweeping liquidity above candle 1 and then close inside the range of candle 1. And as soon as you see this, when price closes below candle 2, you should know that yes, you're going to be continuous selling. So here we see price has closed below candle 2. So as soon as price retraces into the candle that closed below candle 2, you can place your trade. But how do you refine your trade? Now, is for you to go to the 5 minutes time frame. You can refine your trade and use various confirmatory trade entry. Here is the 5 minutes time frame, and what do you see? You see that when price entered into the fair value gap, it created a change in the state of delivery. Now, this is the candles that entered into the fair value gap, and these are the consecutive candles. So this is the change in the state of delivery. You can have it CSD, and then what you need to do as soon as price closes below it, you can place your trade on the 5 minutes time frame. You can place your trade. So here is how that bearish trade started, and you can use this method on the synthetic index. It happened in all the assets. Now let's go back to our daily time frame and look at what price is currently doing. So here from this chart, Like I've explained, we're looking at external range liquidity to internal range liquidity. And we see that price has created this swing. And we frame our trade from this swing and we see that price went bearish. But look at something very important here. Now, this is the consecutive candle that entered into the previous day high. That is this swing. And price violated the low. That is, price closed below the consecutive candle low. So we have what we call change in the state of delivery. You see, price has created a change in the state of delivery. What do you want to see? We want to see price coming into a fair value gap within the range. And if you place your Fibonacci from this high, this low, you will see that price is here to enter into discount level, even though price has touched the change in the state of delivery. But I want to see price coming into this fair value gap or coming into the 50% for me to sell. So if price did not come into the 50%, it's fine because we have a breaker block here. This is a breaker block and which price can hold at the breaker block. Then this fair value gap is my point of interest because I want to see price coming into this fair value gap. And if price come into this fair value gap, we should be able to see our protected high. What do I mean? This 3 candle pattern should appear at the fair value gap. And when this 3 candle pattern appear at the fair value gap, we should frame our trade at candle 1 and candle 2 within the fair value gap. Then we will go to the 1 hour time frame and look out for change in the state of delivery. Now, if we go to the 1 hour time frame, you will see that there is no change in the state of delivery. Price sweep liquidity and is going bullish because price is not ready for bearish move. So I want to see price going from this low up to this level for me to sell, but I will not be selling without following the processes I showed before now. So this is how you can determine your trade. So if you're new to this channel, you can kindly subscribe, and I have a free Telegram group where I post my setup and also discuss with the guys in the community. See you in the next video.